The power struggle between the unipolar and multipolar oil orders, increasingly a zero-sum game, is creating mostly losers so far. But a handful of countries, those that are destinations for friendshoring like Mexico and India, have emerged as winners. A less obvious winner that has seen a dramatic reversal of fortune is Japan. After 3 lost decades, Japan is determined to make the most of its improved geoeconomic position. But will it be able to manage the growing conflict between its 2 largest customers, China and the US? Is it possible that the global tech race might usher in a new Japanese industrial renaissance? The Japanese stock market is on fire. It is already up 17% year to date, easily the best performing stock market in the world. This rally has propelled the Nikkei 225 beyond the previous peak reached in 1989. Japan's GDP is forecast to grow 1% in 2024. That might not seem very fast, but it is by Japanese standards. Indeed, for 2024, not only Japan is likely to expand faster than its trend growth, but it is expected to be the only major developed economies to do so. In my ranking of the difference between expected growth in 2024 and trend growth, even though Japan will still lag the likes of Mexico and India, it will be quite a bit ahead of its neighbors like China and South Korea. Japan has gone through 3 lost decades of economic stagnation and deflation. From time to time, the market has gotten seduced by the idea of an imminent comeback of the Japan Inc. Will this time be different? In a strange way, Japan has been a huge beneficiary of the post-pandemic economic environment. Japan has been struggling against deflation for the past 20 years. Deflation meant that Japan was stuck in what Paul Krugman called a liquidity trap. Ironically, the global inflation shock of the past 2 years released Japan from this liquidity trap by pushing Japanese real interest rates into deeply negative territory. The global inflation shock also resulted in a divergence in monetary policy between Japan and most of the rest of the world. The increasing interest rate differential between the rest of the world and Japan meant a steady depreciation of the Japanese yen. Indeed, the Japanese yen has weakened to 150 against the US dollar, its weakest level in more than 30 years. Adjusted for inflation differential, the yen is now weaker against the US dollar than it was even before the Plaza Accord in September 1985. This is important, and not only symbolically. Many economists believe that the Plaza Accord was a major contributor to Japan's lost decades. By the 1980s, Japan had become the workshop for the world. Japanese exports to the US were surging. By 1985, US trade deficit with Japan had reached a whopping $600 billion, up from just $150 billion in 1980. At the Plaza Accord, the US forced Japan to accept a large appreciation of the yen. This concession by Tokyo didn't stop Ronald Reagan from unleashing a trade war on Japan by imposing a 100% tariff on Japanese electronic goods less than 2 years later. To cushion against the dramatic appreciation of the yen, the Bank of Japan cut interest rates sharply in 1986 and 1987. This helped inflate a massive bubble of the Japanese stock market and real estate market. The bursting of the bubble 3 years later brought Japan's economic miracle to an end. The size of Japan's GDP relative to that of the US peaked at 70% in the mid-1990s and has been since declining almost in a straight line to currently just 15%. In geoeconomic terms, the decline of Japan's economy can be viewed as a lesson about the risk of challenging the US economic hegemony. If the appreciation of the yen played a big part behind Japan's economic decline, will the depreciation of the yen over the past 3 years bring about a Japanese economic revival? So far, there's no evidence to suggest that a cheaper yen is giving a boost to Japanese exports. Japanese export volume is higher than before the pandemic, but not by very much. But a weaker yen is driving up the prices in yen that exporters receive for their goods and services. This is resulting in a massive improvement in their profit margins. In the manufacturing sector, for example, profits are 25% higher than before the pandemic and 50% higher than the average since 2000. Improved profitability means that companies can offer higher wages to workers. With the unemployment rate at just 2.4%, companies have no choice but to pay more to keep their workers, not to mention to attract new ones. Last month, Honda agreed to a 5.6% wage increase with its union. Aeon, a major retailer, announced that the pay for full-time workers will rise 6.4% above last year's 5%. With the annual spring wage negotiation kicking off this week poised to lock in record wage gains, Japan is on the verge of finally escaping from the curse of deflation that's plagued its economy for the past 20 years. However tempting, it would be wrong to think that Japan's economic revival is only about a weak yen. Indeed, the correlation between the returns of the Japanese stock market and the returns of the yen against the dollar is currently only about minus 20%, compared to the average minus 60% prior to the pandemic. Something else is going on. The intensifying US-China rivalry is creating both challenges and opportunities for Japan. China and the US are Japan's largest and second largest export destination. The fact that Japan's exports to China and its exports to the US both grew 5% over the past 3 months compared to a year earlier suggests that Japan is managing the conflict between its two largest customers reasonably well. Under Prime Minister Kishida, Japan has launched the biggest military buildup since World War II and is actively countering China's influence in the region. However, Kishida has been careful not to jeopardize Japan's economic ties with China. The tech war between the US and China is so far playing to Japan's advantage. TSMC, the world's largest chip maker, opened its first factory in Japan last week. And Tokyo has already pledged a further $5 billion towards the construction of a second TSMC factory. Japan once led the world in microchips, controlling 50% of the global chip production at the end of the 1980s. The US-China rivalry has breathed new life into the Japanese semiconductor industry. TSMC founder Morris Chang last week predicted a chip renaissance in Japan. In the US-China tech war over electric vehicles, Tesla and BYD are locked in a bruising battle in a market that's growing more slowly than expected. Meanwhile, Toyota, the #1 car maker in the world, is reaping the rewards of its commitment to hybrid vehicles that are now seeing a revival of interest. In the first 3 quarters of its current fiscal year, Toyota sold more than 2.64 million hybrid EVs, a 40% increase from 2022. This resulted in a 100% increase in its operating income. The US-China rivalry is also accelerating the onshoring of manufacturing. With Japan's leadership in robotics built up over the past 2 decades, Japanese automation equipment manufacturers are well positioned to benefit from the pickup in global demand for robots since the pandemic that's expected to hit 720,000 units by 2026. ChatGPT is only a little more than a year old, but the coming together of generative AI and robotics is already creating smarter robots that have the potential to help Japan achieve higher structural growth in spite of its aging population. In space, Japan successfully launched its new H-3 flagship rocket last month, putting its space program back on track after multiple setbacks last year. This does not mean that Japan will start to challenge the dominance of SpaceX anytime soon, but it does mean that it has a foothold in another important global tech race. The Japanese government plans to launch about 20 satellites and probes with H-3 rockets by 2030 for domestic use. In defense, Japan recently revised its long-held ban of the export of deadly weapons in an attempt to boost its defense industry. It just started exporting Patriot missiles to the United States. And it is now considering exporting 155mm artillery shells to the United Kingdom. Given rising defense spending around the world and the decline of the defense industrial base in the US and in Europe, Japan is well positioned to emerge as a major arms exporter. What's the bottom line? Japanese technology and manufacturing will be a major beneficiary of the intensifying rivalry between the US and China. There's a famous Chinese saying, good feng shui rotates every 20 years. 10 years in favor of the East Riverside, 10 years in favor of the West Riverside. In 1986, at the height of Japan's manufacturing prowess, Japan accounted for 10% of the world's exports. In that year, China accounted barely 1.5% of the world's exports. 36 years later, Japan accounts for barely 3% of the world's exports, while China's share of world exports has soared to 15%, 5 times higher than that of Japan. There is no denying that the emergence of China as the world's manufacturing workshop over the past 20 years contributed importantly to Japan's poor economic performance. But fortunes of these two countries are turning again. One thing is certain. After 3 lost decades, Japanese policymakers will try to make as much out of Japan's improved position as possible. Chinese policymakers are determined to not repeat Japan's mistakes 30 years ago. But it may be already too late. My bet is that the Japanese yen, the most undervalued currency in the world, will likely appreciate against the Chinese RMB in 2024. Thank you for listening. If you got something out of this program, please hit like and subscribe to my free YouTube channel. Let me know what you think by posting your comments on the video. If you want to learn more about my investment strategy, come visit us at davidwunbound.com.